Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host, and today I'm joined with my good friend Barb Friedberg. Hey, Barb.
Hey, how's everyone doing today?
Good. Well, Barb is a much more attractive version of Doug. So, Doug is usually our staple on Fridays. Barb has agreed to join us. Everyone else has decided to take off for the long weekend, and Barb and I stuck around to make sure that everyone here is getting what they paid for, which isn't hard to do since it's free. But anyway, as we get started here, wanted to kind of dive right in because even though a lot is going on at the same time, nothing's going on. It is summertime. The markets are slow. The economic data is slower, and there's I guess I would say that the market's on the edge of some things, which we'll talk about. But let me give the mic to Barb here because Barb doesn't get enough chance to talk. So we had some numbers out this week. We had the CP number. We had the employment numbers. So why don't you start with us, Barb? What have we seen, and what should we be thinking about?
Okay, well, first of all, we're going to revolve this all around the man of the hour, who is Jerome Powell, the Secretary of the Treasury. So, what he says matters. So, first, we'll talk about the numbers, and then we'll talk about Jerome Powell because he's the guy that pretty much, some people say he's more important than the president. I'll leave that up to you to decide. So,
We don't talk politics in this show, Barb, but I
okay,
believe you're
well,
probably correct.
okay, good. As long as I'm correct, I'm happy.
Yep.
So CPE reported approximately 3.2% inflation rate over the last 12 months as of July. They haven't figured August in yet. That'll come in September. So 3.2% inflation. Well, if y'all remember last year it was around 7 plus. We all should be dancing a jig, right? I mean, the numbers sound good, but just to throw in a little reminder, inflation is different for every one of you. If you don't drive much, gas inflation doesn't really matter. If you don't eat, food inflation doesn't matter. If you don't pay rent inflation doesn't matter. So we all have our own private inflation rate, but in general, the aggregate number that they're using today is 3.2. So here's where our main player, Jerome Powell, comes in. He's charged with monetary policy for the US of A, and he has a mission to keep inflation around 2%. That is, Kirk, need I say, kind of an arbitrary number that we feel is good for the economy, doesn't stifle growth, lets it grow enough. So there is conversation that there may be another rate hike in the works. I'm going to say a few more things and then let Kirk chime in. The Federal Reserve, headed by, again, I said Treasury Secretary. I meant Federal Reserve Bank Chief,
It's Friday,
Jerome
Barb. Don't worry.
Powell. If anyone caught my error, just, send me a horrible email and I'll stick with all the rest. Fed Reserve hiked interest rates up to roughly 5.5%. That impacts all your credit rates, your mortgage rate, your bank savings rate, and money market fund rate, which savers love, borrowers hate. This is the highest level of interest rates in 22 years. So we're going to get into if inflation still isn't at the level that the Fed is striving for. Does that mean we're going to have another interest rate hike? How's that going to impact our economy? And we always like to talk about what do we do about this stuff? So, Kirk, I'm going to let you get a word in edgewise, and then, we'll continue.
Yeah. So it's interesting. I mean, this is the market's been debating: are they going to have another interest rate hike? The real answer is who cares? You're talking about 25 basis points compared to going from 0 to basically 5.5% in the matter of a year. Who cares? It's 25 basis points. Does it matter? Not really. But what it does matter to the market, here's the problem. The rate itself is really less important than the signaling. And the market is a discounting mechanism about 6 months in the future. So whatever you think is going to happen in 6 months, people are preparing for today and they're pricing it in today. That's generally how the market works. So whatever the prices are, it's where people think that the data is going to show up 6 months from now. So if the data is off from expectations, the market's going to change accordingly. Now, right now, people think that rates are going to stay approximately where they are for most of next year, and then they're going to start dropping about mid to late next year, about 1% about 1.25%, I guess, from where they are now. So if they raise rates, it signals to the market that, hey, we're going to stick around for a while. If they stay pat, the market's going to say, hey, we're on track, because their being on track means that things aren't going to change for the next 6 months, and then they might start to change. So it's within the realm. But if they raise, it means that, oh well, we might have to push it out even further, which means that whatever they're discounting for their numbers is not going to account for the fact that they're not going to go down as quick as we thought. That's the problem. So the fact is what we're seeing in real time versus what we're seeing in 6 months from now are two very different things. And the market has been very much behind the curve in the 6 month out window. For the past 2 years, the market has predicting basically everything wrong. So in December of 21, they predicted that, or based on the prices, nothing was going to change. January 2nd, all of a sudden, all right, stocks, yields are going to go up, bonds are going to go down, stocks are going to go down. Everything was, Harry Carey. And like, what happened January 2nd? Well, nothing happened except for people just woke up and said, oh, he's really going to raise rates. And then they kept raising them and kept raising them faster and faster throughout the time period. People were like, whoa, what's going on? I can't keep up. Well, the reality is the market just wasn't paying attention. And I think we recall another time where that happened, 2008, maybe, ring a bell, where the market wasn't paying attention. I was on vacation 2 weeks ago, and I'm on semi-vacation this week, and I watched The Big Short. Love that. It's one of my favorite movies. Love it. Wolf of Wall Street doesn't hold a candle to this. The Big Short is so brilliantly done. And one of the scenes that I can't remember the guy's name. The guy from Office Space, Michael from Office Space. He was going around. He's like, I don't get it. He's like, and his team were like, I don't get it. Like, what are these guys doing? They're like the mortgage brokers, like they're bragging. Like, really? They're bragging how they're stealing money from people? And they were going through all these stuff. They couldn't figure out, like, why are people not seeing this? And he's like, people are asleep at the switch. People are corrupt. They're asleep. They're not paying attention. That's how crashes happen, because people are not paying attention. They're comfortable. They're comfy, cozy in their little bubble, and everything's great. And then when something changes, like, whoa, I wasn't prepared for that. Like, well, you should have been. Powell was talking about this for like 12 months prior to actually raising rates, so it wasn't a secret. And now, he's kind of in this more like, I don't know, maybe I'll raise rates, maybe I won't. If I had to predict, and you know how we think about predictions on the show, if I had to predict, I'd say he probably won't raise rates. If he does, it's more like, let's stick a nail in the coffin, and then we're gonna go to sleep for a while. That'd be, I could see the argument for that. I don't think it's needed, because I think right now we have 5.5% rates. You're getting treasuries 5.5%. Great. Will that continue for the next 2 years? I don't know. But I think if you keep it there for a good 12 months, you're probably not going to see inflation come back to the same extent. I think, frankly, we talked about this in the show a lot. I don't see why they'd ever lower rates given the conditions we have right now. So if conditions stay the same, where people are feeling kind of good, things kind of hurt with inflation, but they're still kind of feeling good. People are still overpaying for real estate. I just talked to somebody this morning and said they're overpaying for classic cars in the last few weeks. People were overpaying by like tens of thousands of dollars for classic cars. People still have stupid money, apparently. So as long as that's the case and people are feeling good, things aren't going to change, right? But all of a sudden, at some point, people start to not feel so good. That's going to change the economy. So if you have 5.5% rates, people might not buy and sell real estate because they can't afford it. At some point, that'll come down. At some point, the stock market will start to feel it, but that could be a few years out. So I think the thing to keep in mind is that rates are the are the lever that is going to move the economy from here on out. Now we've started to see, and I'll let Barb take the wheel here for a bit, but we've started to see a softening, a little bit of employment, which is really the only metric that people can point to and say, hey, what's the Fed looking at? Because employment's been pretty strong, and everything else is showing a little bit weaker. So you should be able to, you know, change things around. But the Fed's like, nope, we're going to stay where we are. So a lot of people think that employment is the reason that they're sticking with it. Now, I don't declare myself an economist, even though I have a degree in that. I don't like calling myself an economist because I just don't respect the profession. But they are important, and it's a dismal science for a reason. So if you think about, like, it's basically just a test tube, and they just kind of like try things and see what happens. Like there's no facts. It's not science. It's an art for a reason. So if you look at Powell, he's saying, well, here's what happened before. We're not going to do that. In the 70s, we dropped rates and inflation spiked up. We're not doing that again. So he's going to keep rates higher longer than most people think because of that. That is the reason he's doing it. And frankly, even if employment starts to go down to normalish place, why would you lower rates? I mean, if rates are sustainable, what's the reason for lowering rates? So, Barb, why don't you talk a little bit about that and what you've seen out this week with the employment picture?
Kirk, I really liked what you said about why don't they just keep rates where they are at? And for some historical context, the average 10-year bond rate historically past 100 over the past 100 years or so, guess what it is? You think it's 2%, 3%? No, it is 5%. For those of you that are very young, I mean, these recent near zero interest rates are like, they're unheard of. You know, I've been investing for 40 years. I am a student of market history, and the average interest rate for a 10-year bond over years is 5%. Okay. And the economy has chugged along pretty well with that rate of an interest rate. So, although, yes, we are at crazy high interest rates as of, in contrast with the last since, 10, 15 years, but this is like really normal. Okay. So, now on to job growth. So, this blew my mind too. August job growth slowed to 177,000 new jobs in August versus 371,000 in July. Again, take me back. George W. Bush. I remember him saying, we're going to get 150,000 job growth this month. Isn't that awesome? I wouldn't be whining about 177,000 new jobs. Historically, again, that's not bad. The fact that we had 371,000 new jobs in July, that's kind of an anomaly if you look at the historical numbers. So, again, the news is saying the labor market is cooling. Okay. This is the lowest level of available job openings in 2 years. Okay. Again, for you youngsters out there where you can just snap your fingers and a million jobs are waiting for you, that is not the norm. Typically, there are fewer jobs available. And again, we're always looking for that equilibrium between supply and demand that keeps the economy in a sweet spot. So, a couple more things, then I'll turn it over to Kirk. Economic growth has been propelled by the strong labor market. That's one thing that is contributing to inflation. Oh, no, obviously not the only. Supply chain issues were another contributor. So the question comes up, though, will the quote unquote slowing labor market hinder economic growth? Economists are worried that if inflation falls to 2%, that might cause a damper on economic growth. And what does a damper on economic growth means? Well, it means like lower gross domestic product or GDP that could stabilize, or even lower wages. It could do things like increase the unemployment rate. It could, on the plus side, it could reduce price inflation. So again, these are all relative terms, and if they want to say 177,000 jobs in August is like something to worry about, okay, I guess relatively you could see it that way.
This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to the show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today. So it's interesting. So I don't put a lot of stock into the employment numbers. It's not a data point I spend a lot of time with. It is an important one. The problem with the unemployment rate and employment data is the headline numbers are usually things people look at, but they're not necessarily the best numbers to look at. And I actually just learned something this week interviewing one of the guests, Mark Yusko, who is a phenomenal investor, runs a fund, used to run an endowment. He's a very sharp guy. And I was talking to him, and you'll hear this on the episode when it comes out. But we were talking about the unemployment rate, and he mentioned something that I wasn't even aware that was the case. Is that they remove people of a certain age from the employment numbers. I forget if it's 60 or 65, and he said they remove them from the numbers. Like they're just not there. You could still be working, and they don't count you, which I thought was interesting. But that aside, and I haven't looked into it, so I just mention it because he's smart. He's not going to lie about it. But it's interesting because the problem with the unemployment rate has always been the same. It is not accurate. If you're unemployed for a period of time, or you say that you're not looking currently, you're not on the unemployment rate. So if it's 3%, and you're in one of the survey, because they do surveys. So if they do a survey, and be like, yeah, I'm not looking like right now. I'm just taking the summer off. Like let's say you're a teacher, for instance, and you're just like, yeah, I'm just taking the summer off. Like you're not employed. And teacher's a bad example because I think technically they're employed, but if you just take time off, like you're doing a sabbatical or something, you're not counted. Like why aren't you counted? You're a person. You're a person of working age. So the statistics that the government uses, and I'm not saying that they're manipulating them, even though I think there's probably some of that going on. What I'm saying, I mean, they're using the same metric for long periods of time. So it's all relative. And this is why I don't put a lot of stock into data points, because it's all relative. You're looking at it, and how is it relative to something else? So if you're looking at the unemployed, and I'll give you a good example, and I'm going to try to share this if I can, because it's a really good. There's a few good charts here. Let me share this. Let me see. Share my screen here. Here we go. All right. So here is the the Fred, or the basically Federal Reserve Economic Data by St. Louis Fed. It's really good. I love this. This is, by the way, if you don't know this exists, check it out. It's a bunch of publicly available data. You can chart it. You can come up with your own statistics. It's a phenomenal resource. I absolutely love it. And for those you data geeks out there like me, you're going to love it too. So here's the unemployment rate historically. Okay, this goes back to 1948 up until August 1st of this year. So it doesn't include, the recent numbers. But if you look at this, and I bring this up because what's important is not the number, right? So if you look in the 1953, this went down to 2.6. And if you look in 69, it went to 3.4. And then the low point was 5.7 and 5 and 4 and 4.5. The thing to look at is how is it doing relative to other years? So, if you look at 2020, obviously there was a high unemployment rate. A lot of people were unemployed. I think it's funny that this only went to 14. It probably should have been to about 50%. But anyway, so if you look at these numbers, you could say, all right, well, that's a spike. Okay, we can ignore that because we know why it happened. And it went back down to 3.6. Well, should it be 3.6? I don't know, right? A lot of people retired. So they're no longer on the rolls anymore, which means they're not unemployed. So if you have baby boomers which retired in mass, right? A bunch of them retired. They figured, I'm not putting up with this crap. This is all BS. I'm just going to retire now. I'm not going to have to fight with my employer about getting a shot or getting a mask or whether I can come to the office or not. I'm just going to retire. Screw you all. I'm going home. So if you look at the numbers, prior to COVID, it was 3.6. Right now, it's at 3.4. It's pretty close to where it was before. Is it going to go lower? Probably not. Like it looks like we're at a capacity limit for where the economy is now. So if you look at it relative to other times, so for example, if you looked at prior to 2008, 2007, it was 4.6, 4.5, 4.6, 4.4, right in that range. And after 2008, it peaked in December of 2009 at right around 10%. Okay. I would argue it was higher. I would argue it would be like 15%, maybe even 20. But that aside, it says it here it was 10. And this is why I don't worry about manipulating data, because you're looking for the trend, not the data point. So I don't, some people claim it, by the old metrics, it would have been like 25%. Well, I don't know. I'm not going to sit here and say I know the data is accurate, but as a trend, it peaked at that point in time and started to come down. And then when it comes down, it hits a low point, which it seems like we're at now. Now, it's probably not going to go lower because it seems like we're at a capacity limit, but it can go up. And so what you want to look for is, where are the trends? Are the trends going up or are they sideways? And whether it's up or down 177,000, I frankly don't know what that number means. I haven't dug into the data points. Is it lower than expected? Yes. Does it matter? I don't know, right? Because it's one data point. It's not a trend. Now, if it starts to go negative and it starts to go much lower, okay, we could argue maybe there's something going on here we should pay attention to. But for now, I look at it as noise. It's data noise. It's just another data point in the chain. It's not anomalous. Here's another. This is the unemployment rate, another metric. I don't like that one actually. And here's one for the PCE we were talking about earlier. And so, you can look at it. Obviously, it's not the CPI, so it's still high. The CPI is lower. It's a 3.2. This is not updated, but if you look at the history of it, it's a lot higher than it was. And the early 2000s was anomalous, right? Which was the inflation rate was really low. You look in the 70s, it's obviously a lot higher. And so you want to understand the trend. If it's not going down quick enough, why, right? So look at the trends. Don't get all caught up in the data points, because that's just going to cause you to go crazy. And frankly, it's not going to help you, because it's not showing you the trend. It's just showing you like, oh, okay, there was a data point. Next month, if it's lower, okay, now let's start paying attention. To me, that's important. Now, if you're running a hedge fund, if you're running, hundreds of billions of dollars, maybe you have a team of people who, are sitting there, micromanaging the data. Okay, but most average investors, this does not matter. What you should do is look at the data point and say, okay, how did the market react to it? That's a better data point for average investors. How is the market reading this? Now, we're live right now. I'm going to look at the market. And what does the market say? Well, the market says we don't care. The S&P is pretty much flat. The NASDAQ is down a little bit. The Russell is up, which isn't a surprise because it's been beaten down for a long time. It's actually having an up day. Internationally, it looks like it's mixed, some up, some down. Bonds look like they're down. So you want to see how the different markets are reacting to this to see how are the smart people in the room. And I use this as a metric, and I just want to lay this out. I use this as a metric because most people, and I would say most people listening to this, there are some professionals that listen to the show, but most people listening to this, you're not an economist, you're not a hedge fund manager that manages $1 trillion. You're not those things. You're an employee of a company who does something completely different, and you're worried about your money, and you're trying to make sure your money's safe, and you learn how to invest better. That's who you are, right? So, are you going to go micromanage this data? Well, if you do, let me know. I'll happily take notes from you because I don't micromanage the data. It's not worth it. It's not worth it because it's not going to give you much edge. The way this is like a hack, right? So this is a hack that I've used for years. Is I look at the data and I look at how the market reacts to it, and it's usually like a 24-hour cycle because right away it reacts, and then within 24 hours, the next day you're like, all right, does the market really agree with that? Because it's had time to digest the numbers. So how it reacts is more important than the number because if the market reacts poorly, it's say, okay, this is something I should pay attention to. If the market reacts well, you say, all right, this is something I should pay attention to. If the market doesn't react like it kind of is today, you could say, all right, the market doesn't really care, so let me just ignore this data point. That is a better overlay for investors to use with data because otherwise you're just wasting your time sifting through data. And if you like data, God love you. But I love data. I'm a data geek. But even I have limits, and I look at it and say, this is enough for me. I'm going to shortcut this. I'm going to use my Cliff Notes and look at this, and that's going to give me all the data I need. Is the market as a whole is smarter than any single person. Sorry, Jerome Powell, the market is smarter than any one person. And I know people at the Fed, people in the government, they want to tell you how to run your lives, but the reality is the market is an aggregate of every single person who's buying and selling stocks on the market aggregated in one price. That is a smarter metric than any single one person. That's why you have free markets. That's why we have the stock market, the economy. That's why it runs how it does. That's why our economy is one of the best in the world because we have a sort of free market, which allows market participants to price it accurately. That's what you want to look at. So, Barb, I want to let you. I don't want to hog the whole mic here, but what are your thoughts?
Well, I kind of want to wrap it up with some to-dos. And how does this impact me? I mean, Kirk and I find this stuff really interesting and it's fascinating, but I don't know about you, Kirk. I don't act on this information. I mean, this kind of data comes out either weekly or monthly or quarterly. And the question is, am I going to shift my investing to match data that comes from the economy? Well, only a little. And I'll tell you how and why. I'm basically a value investor. I'm not a momentum investor in general. Momentum investors go, hey, prices are going up. Let me glob onto this trend so I can ride it up. And that's a legit strategy. But I'm kind of like more of a market matching gal. I just want returns that are going to match the market, and I'm happy. So what's my secret though? I know there are times when the market is going to crash. And so I kind of typically leave a little bit of cash on the side. So when that crash happens, I can deploy more money into the markets at lower points. So that's my one hack. My second hack is dollar cost averaging. Because with dollar cost averaging, what you will do, and that means just putting a set amount into the market, periodically, whether it be monthly or quarterly. And you're probably already doing that through your 401k, or maybe an auto transfer every month into your brokerage account. But automatically, you're buying more shares when shares are cheaper. So that's how I make sense of all this. And I want to thank you guys for listening, and, have a great Labor Day.
All right. Well, sounds like Barb is wrapping it up for the day. Well, we can keep it short because it is Labor Day, and people want to get off to their wherever they're going for the weekend. I'm off to a soccer tournament with my youngest, and pretty much just sitting around enjoying the nice weather, this beautiful weather we're having in the next 10 days. I'm super excited that we're gonna have a beautiful Labor Day here. So yeah. So Barb, where can people find more about you?
Just check me out at Barbara Friedberg Personal Finance, my website, or Google me. I'm pretty much online.
All right. Well, check her out. She's all over the interwebs. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.